Dow Jones, Nikkei, Hang Seng, Nifty, Sensex. All major global markets are in red. Now, Monday was expected to be bad for domestic markets, especially after Nasdaq's entry into the bearish territory was confirmed on Friday. But a crash of 4,000 points in Sensex and 1,000 points in Nifty has spooked everybody. The biggest post-facto rationalization is, of course, Trump tariffs. But are there other factors at play? And most importantly, have the markets baked in all the negatives in one go, or is this the beginning of a series of down moves? I'm Abhishek Singh, and you're watching The Mint. I'm joined by Karan Agarwal, co-founder and chief investment officer at Elever. With him, we will try to find the answers to all the questions about the markets that must be troubling you at this point. Karan, welcome.
Hey Abhishek, how are you doing?
As I was telling you earlier, been obsessed with what's happening in the markets and trying to, stay as up to date as I could before, of course, entering the studio and starting the series of interviews which are lined up. The first one, of course, is with you. So let's just start there. What happened today?
See, the problem is that people are looking Trump tariffs in isolation. Like it's some isolated event and some megalomaniac has come into power in US and he's doing his own thing and tariffs are there and one day they will go away and things will be normal. Okay. So overall story is not like that. Okay.
Okay.
So in general, the thing is
But
that
would you say,
for
but
last
would you
50
say the
years,
tariffs were the primary trigger? Okay.
they're just a stepping stone towards a larger thing that is unfolding in global economics. Okay.
Sure.
So, in last 50 years, if you look at the last 50 years, since the end of gold standard in 1971, the business
Yeah.
model is very simple. Okay, US will print the dollar. Other people will produce goods and services. China is producing manufacturing goods. Germany is doing high tech engineering. Okay, same as Japan. India is doing services, right? Okay, so other people will produce goods and services. US would pay in dollars for those services, and we will buy from that money. Our government will buy a treasury bond, return the money to US. Okay, and this cycle would continue. Okay, so that was a cozy arrangement that has been going on for quite long.
You're
If you
saying
look at the
US was expected to be, the supplier of the capital. This capital was invested across the world in various countries, and
yes,
various countries produced either a particular good or a number of goods
services.
and services, and that is what the arrangement was. But all of that is changing now.
That was the arrangement, and they were buying using those reserves. They built the reserves using that capital, and they're buying the US bonds, treasury bonds, and returning the money to US to spend.
Right.
Okay, so that was a cycle. That is how the things work. Okay, and it was working so well for everybody till now. Okay, what changed in last few years is that US started accumulating debt at pretty fast clip.
Right.
Okay, last year your interest payments on treasuries crossed 1 trillion. Okay,
1 trillion.
so
Yes.
pretty soon in next 2 to 3 years we would be in situation where to just to pay interest US would have to borrow. Okay, so the
Yeah.
people who are buying treasury bonds, they are looking at a black hole of capital. They might never get back their money. There's a probability that at some point of time, money would never come back. Okay, it will just keep rotating because you just keep throwing good money after the bad money. Okay,
Right.
so US reached a situation where it could not borrow more. Okay, so this arrangement it cannot sustain. So if be it Trump, be it Obama, be it Biden, anybody who is there, okay, they have to trigger a recession. We already spoke 2 months ago, if you remember. Okay,
Yeah.
regarding
Of
this,
course.
they
Yeah.
they have to trigger a recession. Okay, bring the interest rates down, cost of funding down. Okay, create a bear market in US, force US investors to buy treasury bonds
US bonds.
and
Yes.
refinance and support the refinancing of US bonds because foreigners are no longer ready to foot the bill. Okay, so tariffs are a part of it. It is a part of a messaging that US cannot support this system anymore. Okay, if you want to sell to US people, produce in US. Okay, we cannot afford this import bill. Okay, it's not like that these are final tariffs and everything. There would be some arrangement that would be there. Okay, at the end of the
Yeah.
day, okay, some middle ground would be there, but definitely things won't be as it was till 1 year ago. You cannot expect status quo to return ever.
If I rephrase what you said and sum it up in one line and make it a question. And that would be that this was triggered to protect the US bonds market. And of course, the fact that the debt that US has now has become
US
unbearable.
simple thing is that US is adding 2 trillion of debt every year.
Yeah.
They need to pay somewhere around 1.5 trillion dollars in interest. They don't have money anymore. World is no longer ready to lend them money to do
Hmm.
that. They have no option but to shrink their balance sheet, shrink the budget. On multiple fronts, things are happening. Okay, they are going for Doge initiative where they are trying to cut to those 2 trillions. Okay, they are trying to they want to impose the tariff to reduce the import bill. Okay, basically idea is to kill the inflation eventually by triggering a
Hmm.
recession,
Hmm.
bring the interest rates low. Okay, so that
Hmm.
refinancing can come at lower cost, reducing the
Hmm.
burden. Okay,
Hmm.
trigger a bear market
Hmm.
in equities. Okay, and forcing local investors, US citizens, pensioners,
Hmm.
savers, households, basically to put money into bonds as a safe haven.
Hmm.
Okay,
Hmm.
so that is the final plan. Right now, this is what is
Right.
unfolding. In next 3-4 months, this is what is going to happen. Okay, because
Hmm.
US that option is gone. Status quo, continuing business as usual, what I've seen in last 50 years is gone. US is going through a restructuring. Okay, and then this restructuring will continue for next 2-3 years in bits and pieces. Okay, so
Right.
this is the round
Which
one
means,
that we are looking at.
sure. Which means there's going to be a major capital outflow. We have seen some of it. Of course, it started in September last year. We are in
Mhm.
April 2025. The capital outflow, which started last year and of course picked up in January, February this year, 2025, is only going to get worse. You're saying a lot of more foreign capital will end up going back to the US, perhaps in this case, which means worse times ahead
No,
for Indian
I
market.
would say it's other way around. Okay,
Okay.
I would say it's other way around. See, the thing is, US market has given exceptional returns in last 10 years. Okay, nobody can
Yes.
deny that. Okay, there is not if you compare the returns of Indian market in dollar terms and US terms, there is not much of a delta that is there that
Hmm.
justify the
Hmm.
risk associated currency risk and foreign market risk associated with Indian market. Okay, in general.
Hmm.
Okay,
Right.
so what we are looking at underwhelming returns from US market for next 3 years.
Hmm.
Okay, so FIIs would actually look for a market where they can make higher returns. Okay, Indian market already, if you look at the Indian market trajectory in last 6 months, it was a worst performing market by good
Yeah.
distance. Hong Kong market was trading, Hang Seng was trading till 1 month back at 52
Yeah.
week high. Okay, DAX was
Hmm.
trading at 24,000 levels, never seen before. Okay,
Yeah.
CAC was at near 52 week high. S&P was there. Indian market was
Hmm.
trading at some 15% discount to all-time highs. Okay,
Yeah.
so it was already in that. If you look at the in relative terms in technical charts, it was already
Hmm.
in the reversal zone where it's going to outperform the global markets. Okay,
Right.
so from April end, you can see FIIs actually rotating towards Indian equities. Okay,
Right.
we can see a start of the cycle. FIIs were looking for other markets since January. Okay, so
Hmm.
when the first tariffs were announced at the end of
Hmm.
January, they went into
Hmm.
Germany and China.
Hmm.
Okay, and those markets made 52-week highs. Okay,
Hmm.
so now, the problem with the tariff regime is that these countries have taken a confrontational approach. Okay,
Right.
they're talking about retaliatory tariffs. Okay,
Counter tariffs.
counter tariffs. They're talking about counter tariffs. Like it's like everybody is trying to play macho man there. Okay,
Yeah. Yeah. Yeah.
it's like tit for tat. Tit for tat
Hmm.
won't work. US market is one of the big largest export market. Okay, US
Hmm.
is holding all the cards. It's like saying that okay, US put some tariffs, some tariffs over export services. So
Hmm.
so IT services. Okay, we say okay, we will also impose some tariffs on US. It won't work that way,
Hmm.
right? It will damage you. So you have
Hmm.
seen US lost 15% of their market cap in last
Hmm.
1 month. China,
Hmm.
with a single announcement that they will impose 34%, similar 34% tariff in
Yep.
retaliation, they lost 15% in a single day.
Yeah.
Okay. So these countries are basically, they would be impacted severely by this tariff war if they indulge in, and they are showing signs of indulging in that tariff war. So India comes out to be suitably, reasonably suitable alternative. Okay.
Hmm.
We are still, there are no signs of any retaliation. Okay. There are signs of a trade deal.
So, Karan, in that case, as you were saying, capital is likely to come back to India by the end of
Yeah.
April and perhaps a little later, if not by the end of April. Then,
Mhm.
what will be the trigger of, trigger for that capital to come back to India? I mean, what will be some of those, first signs which investors out there
See,
can keep an eye on and, of course, take a position in the market?
thing is that a global recession generally has worked in favor of India. If you look in long term, okay, commodity,
Right.
we are a net importer. Even today, we run current account deficit. Okay,
Yes.
so any fall in prices of oil and other commodities would reduce the cost of infrastructure for us. Okay, would support our external finances, would strengthen our currency. Okay,
Hmm.
a stable currency or even a strengthening currency generally a positive for FIIs. Okay,
Okay.
it add to the returns of FIIs in general. Okay,
Hmm.
if you look at the data since Feb end, when we spoke last, okay,
Yeah.
uh, I told you that we are at the end of underperformance cycle. Okay,
Right.
if you've seen the global market, if you compare our performance in last 7 days vis-a-vis global markets, okay,
Yeah.
we have outperformed by good distance. Most of the European benchmarks and Chinese benchmarks, even US benchmarks, if you see, there's a decent delta in performance.
Hmm.
uh,
Hmm.
yeah, if you look at the last 1 month itself, there is a delta of 5 to 10% that is there across
Hmm.
different markets. So it is a
And
so Indian market
this including the 4,000 point fall in crash in Sensex and
today.
about 1,000
Today,
points in Nifty.
I'm talking.
Yeah.
I'm talking about today's fall. So today, S&P Nifty has ended up with nearly 3%, end up with 3%. And most of the Asian markets are down by around 8 to 12%. China is down
Yeah.
by 15%. Even European benchmarks, as we are speaking,
Taiwan
they
is
are
down
down
by
by
about
around 5%.
16%. Yeah.
They're down by around 5%. Dow Jones futures are trading at a discount of around 3%, despite the Friday's fall. Okay,
Hmm.
that 3% is on top of Friday's fall. But we saw on
Yes.
so they are already signs of outperformance. Okay,
Hmm.
so generally people how people see valuations, they compare cross country valuations. That's not a valid
Hmm.
comparison, frankly speaking.
Hmm.
China has been trading a discount for now 20 years. Okay,
Hmm.
with a significant discount. Russia has been trading at discount for God knows when. Okay,
Yeah.
I mean, so in general, services and consumption spending driven economies trade at significant premium to manufacturing driven economies. So there is no fair comparison. Cross country comparison is not fair. What you compare is the valuations with respect to historical trends. Okay,
Right.
till 1 month back, India was the only G20
Hmm.
market that was trading at discount to its
Hmm.
long-term valuation. Okay,
Okay.
so there are already signs of outperformance. Okay,
Hmm.
and you can see once the US market once the home market start to underperform. Okay,
Hmm.
and investors register the fact that okay, they might be underwhelming returns for next 3 years. Okay, they
Hmm.
will look for alternatives, and Indian market would be a major beneficiary, considering Chinese market would be impacted severely by these tariffs. The impact would be much more severe on China than us. Okay,
Right.
as such.
Right.
So
Right.
Indian
So in
market
that
would be
case,
decent. Yeah.
to those who have still not, squared off their positions in the market, their long positions, would you ask them to, wait it out?
See, our view is very clear. We advising clients against putting new capital. Okay, but we are
Okay.
telling them to hold out on their positions. Okay, don't do any tinkering. Don't go for any adventure. Don't go for any short. Nothing. Okay,
Hmm.
just stay there. From April end, they can start putting money back slowly. If they
Hmm.
have money, some money which is there to be put, they can divide into 6 tranches. Okay,
Hmm.
of 10% of 6 tranches, and they can put that money in May, June,
Okay.
July. There might be other dips as well. There might be some sufficient opportunities in the next 3 4 months. Okay, but
Right.
we expect market to start recovery. We believe that bottom made in Feb 2025. That's a hard
Okay.
bottom. Okay,
Hmm.
we expect S&P to take support at around 47 4800 levels, which was the highs before, which were the long term
Yeah.
highs which were taken before Ukraine war. We expect
Hmm.
S&P to take support there. Okay,
Hmm.
and as long as S&P don't breach those levels, we don't expect a Nifty 50 to make new bottoms. Okay, so these
All
are
right.
these are hard bottoms that were made in Feb. Okay, we don't expect it to go beyond 21,500. Hardly there would be 1 or 2% leakage if it is there. Okay, we don't expect
Right.
market to reach that, but say, having said that, there would be sufficient buying opportunities that would be spread across next 6 months. Okay, as the
Hmm.
world is going for a reset, okay,
Hmm.
we might see sufficient buying opportunities over the next 6 months. As per
Hmm.
our analysis, we see markets making new highs in September. Okay, and we expect at least 20 to 25% upside by end of the year from these levels. Okay.
20 to 25%. That'll be massive.
Yeah.
Having said that, what is your view about gold?
See, gold is expected in general when US is going through recession and there's they are going through reset, a disturbance.
Hmm.
Okay, and we can reasonably assume that US dollar printing is coming at its end. Okay, whatever
Hmm.
we have seen in last 40 years is coming at its end. So
Hmm.
gold has actually already appreciated enough considering all these
Right.
factors. Okay,
Yeah.
so we are expecting some sort of a time correction. Time correction
Mhm.
basically means that we expect it to remain range bound for next 6 months
Okay.
before it will go for next round of rally when people actually look for a dollar alternative and might return to gold. So there might be renewed demand for gold 6 to 10 months,
Hmm.
6 to 9 months down the line. But for
Hmm.
right now, at this stage, we expect it to remain, range bound for next
Okay.
6 to 9 months. After 6 to 9 months, you can see renewed demand among central banks and governments as they
Okay.
start to peg their currencies. They need a stable peg before to a benchmark. US dollar
Right.
might lose its relevance as a benchmark. So gold buying has largely been restricted to central banks and they've been heavy buying. If you look at the
Hmm.
central bank data for India, China, demand for gold is mainly coming from central banks and governments, not from public.
Yeah. Yep.
Okay, so they are accumulating gold at fast clip. So people who were ahead of the curve,
Hmm.
brick
They
block,
have already made a
okay,
lot of money
and
because gold made,
Japan, they
you
are
know,
accumulating gold for a
yeah.
quite long time now, 3 4 years. Okay,
Yeah.
gold vaults in London are empty, literally empty.
Yeah.
Uh,
Yeah.
might have heard of it. That
Yes, of course.
London Mercantile Exchange, they don't have gold and silver, and they are running short of that, of the contract
Yeah.
values. Okay,
Because
so
countries, including India, have been
mm,
asking them to send back gold to the tune of, like,
exactly.
140 tons, so on and so
Mm.
forth. So that's a massive quantity.
And that
And
happened some 6 months back when nobody was
yeah,
talking about
yeah,
US recession. Okay, it was
yeah,
basically the narrative was missing from scene. So governments
yeah.
know, but governments knew what was happening. So there were people who were ahead of the curve. Okay, the
Right.
rest of the people would eventually catch up after 6 to 9 months
Hmm.
once they go
Hmm.
through this restructuring exercise. So I see it 6 to 9 months would be stable. Uh,
Okay.
yeah, the prices would remain range bound. There would be some time correction. There might be some correction of 10 to 15%, which might be a buying
Hmm.
opportunity. But eventually, by
Hmm.
end of year, you can see 100,000 rupees for gold, 10 gram gold. That would be there
Right, right. Okay,
by
talking
end
about
of
central
December.
bank, and that's my last question to you, Karan.
Mhm.
But RBI MPC is, of course, going on. And, if we go by reports, I mean, it is being said that RBI is likely to go for 25 BPS rate cut. Uh, do you think that's going to have an effect, that's going to have an impact, and that's being done because of, what's happening in the markets, or it is being done because of the way Indian economy is set up at this point in time?
No, but I think the even if you ignore the markets, what is going on right
Hmm.
now, okay, it was actually already pretty much factored in that RBI would give a 25 basis point cut. Okay,
Right.
if they come with the in general to just to boost the liquidity, okay,
Hmm.
if they come with another some 25 basis point cut in CRR and everything, that would be a surprise. That might see a positive reaction in the market. Okay,
Hmm.
but in general, if you look at the cost of funds, the yields are already down to 6.5%. 10-year bond yields for government of India
Yeah.
bond yields, you see they are down to 6.5%. So cost of
Hmm.
funds for corporates is actually coming down anyway. Okay,
Right.
it is already factored in the market. So market is already factored in 25 basis point cut. It's already there.
Hmm.
Okay,
Hmm.
so markets would only react if there is something else, some CRR cut or some open market operations that are announced, some announcements that which are not factored in. But if you look at the track record of the government and RBI in general, they operate on pretty conservative estimates that they don't care about the market movements. What market doing in last week or going to do in next week, They are not bothered about that. Okay, they
Right.
knew they work on the long term themes. How they already gave a stimulus. There's sufficient stimulus in the market already. Okay,
Hmm.
in terms of
Right.
tax cut, already the kind of liquidity infusion of 100,000 crore is already there.
Hmm.
Okay, that's already given in budget, and then there
Hmm.
is a liquidity operation. OMO operations are being done. So I don't
Hmm.
see any major, incentives to be delivered by RBI. Our government, which is presently in power right now, it doesn't work like that. They don't work on knee-jerk reactions in the market in general. One side effect that can be there of this entire, chaos that is taking place right now
Hmm.
is there would be slowdown in IT hiring. That would be there. It would be negative impact.
Right.
But if you see in general, you have seen from the. I think you must have heard about the startup Mahakumbh, where Piyush
Yes.
Goyal,
Of course.
you
Yes.
know, he gave
Minister of
some
Commerce
comment
and
regarding
Industry backing
he
at.
was not, yeah, he was not happy with the quality of the startups which are there in India, and he want them to move into toward the hard sizes, AI, IoT, some advanced
Hmm.
technologies. Okay, the
Yeah.
problem in India in general, okay, is that talent is not available. Most of the
Mhm.
talent actually fly away to US. Okay,
Right.
even if a person, even if on technology side, an engineer, a coder, even if they're above average, they fly to
Hmm.
US. Okay,
Yeah.
with the restructuring that is happening, you can see a lot of you know we can see a return of talent. Okay, to a large
Mhm.
extent. Even in India, the new cop that would be coming out of college, okay,
Yeah.
they would not be put in regular operations, so they would not be enough operational roles to absorb them.
Hmm.
Okay, so there would be for the first time actually since the
Mhm.
IT took off, there would be abundance of talent in India
Right.
if they want to go for advanced technologies like AI and everything. Okay,
Hmm.
so that might change the face of the way Indian economy is functioning and the way it's evolving in next 6 years. So that's one uh, I would say a kind of black swan impact that can be there.
Right. Right. But
Yeah.
given what AI is doing to tech based companies, it's inevitable that a lot of these jobs are going to go away. And of course,
Yes,
when
gonna
you
go.
add to that what's happening in the markets, of course,
Mhm.
that effect gets compounded.
Definitely, a lot of jobs would go away. There would be a lot of budget cut by the banks when the government shrink their budget, which US is gonna
Hmm.
do. Okay,
Hmm.
there would be budget cuts. There would be budget cuts for IT. There would
Hmm.
be a dearth of new jobs. I'm saying,
Hmm.
but it might force people to look beyond the comfort zone for the first time
Right.
in last 30 years. Okay, they
Right.
might look at real technological innovations. Okay,
Hmm.
uh, right now we are focused on consumer tech mostly.
Yeah.
Okay,
Yeah.
but we can move towards innovation. The problem with startups in India, the talent is actually not available. That's the problem as of today.
Right.
Okay, it's very easy to say that you can do that and that. The problem is that
Hmm.
technology talent is not available. But right now, in next 2 to 3 years, we would be a situation where there will be sufficient talent to actually implement those plans.
All right. Perhaps an
Yeah.
unintended consequence of what is
Yeah.
happening in the markets and in the world and the global economy, but a welcome one nonetheless. Thank you, Karan, for taking the time and talking to us.
Always pleasure to be here, Abhishek. Thank you.